Hello, everybody, and welcome to the first Volland Fireside Chat. I am joined by Kevin Lex Luthringshausen, who used to be a market maker for which firm, Lex?
Boda.
Boda. All
Boda
right.
Trading.
Thank you, Lex, for coming on. Lex before was telling us all about market makers, and now this is part two, where Lex gives us some cool stories about what it's like being in the pit and doing market making. Look at that little grin he's got on his face. He loves this stuff. So this is great. And I don't have to show anything. I'm just going to ask him questions, and I'm going to be interested in learning these things too. And one day maybe we'll talk about it over a glass of whiskey. So first, Lex, tell us when you started, like what was your education background?
Sure.
Who hired you, and who did you work for?
Yeah, good. So I got involved in the options trading business right out of college. Okay. Now that wasn't the original plan. I went to school and my dad always wanted me to be a doctor. We didn't have a doctor in the family anywhere along the way at the time. So I said, okay, I'll fill that bill. Well, along about junior year of college, in my physics class, in physics, I only had to take a semester of it. I had virtually nothing to do with doctoring, but it was enough to say, I hate this and didn't want to do it anymore. So called up dad, said, hey, done, not doing this. He was all bummed, but said, okay, blah, blah, blah. Turned into thinking about being a lawyer was number two. Moved from all the science, math background to English. And ultimately got a degree in English. Decided that law probably wasn't for me either. And one of the mom-dad trips up to school, he said, "Why don't you think about this trading thing?" Because he was in the business. So he goes, "You're young, you have no expenses. I can support you until you get your feet wet and get going." I said, "Okay, that sounds kind of fun." And I knew what I knew about traders back in the mid to late 80s was that the ones down in Chicago were always driving cool Ferraris, and they were always kind of young guys. And I'm not saying guys and gals, because it wasn't gals and it's not sexist. It means that it was a man's place for whatever reason, very physical, back in those days. Now that changed as time went on. So anyway,
I will interrupt you there for one second, because here's a picture of when we went to the Cboe floor.
Yeah.
And if you look at that, there is one girl in that whole group.
Yeah.
It's not changed that much, although probably like some of the market making community probably did change a little bit. But
listen, the reason it was like that, it was that kind of a pit. That was the SPX pit. That pit in the day when it was all open outcry was a physically large pit. And it was, if you were a physically large person, you had an advantage. Okay. So, women are smaller by nature, and it was a tough environment in there because there is elbows, you get hit in the face, people spit on you. They'll punch you, they'll throw you, they'll stick you, they'll do all kinds of crazy things in the heat of that competition. That's not uncommon.
In my early 20s, man, I saw women in mosh pits.
Oh yeah, that's interesting in and of itself. So yeah, it wasn't a big environment for women, but I told my dad I'll get started in this, right? So I did. He had a lot of contacts. He introduced me to some people, and he said, "Look, I can't get you a job. You're going to do that on your own. I'll open the door. You walk through it and figure it out." So I met with some people, and one gentleman said, "Hey, yeah, he knew my dad. He did him basically a favor, hired me." And the way it worked then was that they would provide you with seed capital. Every trader, market maker, needed to have money in the account, obviously, just like any retail trader does. And that was done by the backer. And this was my backer and mentor. He put in $50,000 back in the mid late 80s, which, 50,000. It's a lot of money. He taught me a couple things, not much. I didn't know really any dynamics of options like them and like we know them now. And, talking about charm and Vana, that was a non-existent, didn't exist. But after my week education with him, he said, "Get in there, kid, knock yourself out." So in 6 months, I proceeded to lose all $50,000. Yeah, for real. I'm not making that up. So I'm thinking to myself, I'm 20 at the time. How old was I? I was 22 years old, maybe. And I'm like, okay, strike one. I wonder if I just struck out after seeing one pitch. He throws in another $50,000. He liked me for whatever reason. And
let's say he saw something in you.
Saw something. And then from there, I started figuring it out. Let's just call it that. We can talk about that down the road here. But I started figuring out. And then, my account started gradually growing. And then one time he looked at it, my 50,000 grew to a really, really large 6-figure number, not 7 figures yet, but a 6-figure number. And he looked at me and goes, "What the hell happened to you? I mean, you barely had any money. And I'm looking at this 7-8 months later and you got all this money. What did you do? Did you steal it?" I go, "No, I mean, I just figured something out." So that's kind of my early path. And I started in 87, and we know what happened in 87, right?
Yeah,
I started
before we go there.
Yeah.
I guess the question that's burning in everybody's mind, and probably don't want to wait to hear it, what did you figure out?
Well, that's good.
What was the switch?
Yeah, the switch was, my backer and mentor was a premium buyer. He liked to be long gamma. He paid theta, and he scalped his gamma, efficiently and traded around his gamma well. Now, I tried to do the long gamma part. I didn't get the information in the flyer on how to trade around it and manage the theta, the negative theta every day. So that's where I bled to death, as it were. I didn't manage my inventory well as a premium buyer. So I converted over because everyone in my pit where he put me, they were all premium sellers. And all these guys are making all this money. I'm like, and I started talking to them and learning. So I learned how to, I don't want to say safely at that point in my career. I didn't safely learn how to sell premium. I just learned how to sell premium. And every day I would start making money. And then I'd do a move and, I'd give a little back and I'd manage it during the day and trade out of it and hopefully break even on the bad days. But I didn't have a clear risk defined, set of rules. And that hurt me. We'll talk about that later, but that hurt me in one big event. And then I really honed it in after that. And then from there, I really never looked back. It was just very consistent. We built a trading firm and blah, blah, blah. So it was a big defining event in my life when I learned how to sell premium safely and trade it well. That was a big difference.
Okay. That's cool.
Yeah.
So when you were working in the pit, what was your typical day like? Like, what did you you wake up and you go into work and then what?
Yeah. So most people think, there's a lot of planning, like for the market maker. Again, I'm speaking way back when. It's way different now. We can, if you want to know about that, we can talk about that later. But back in that day, you were a sole proprietor, right? It's me and my little uniform. You can see it back behind me. That's my trading jacket. You had to have one of those. You had to have a tie on, blah, blah, blah. So I'm a sole proprietor. So my day, I didn't have anyone to really chat with and go over strategy. It was just me. And I just dealt with my own little book of inventory. So we didn't read charts. Okay. We didn't have that kind of data. We didn't know what a chart was. We were students in implied volatility and we were students in relationships. So all the synthetics of the world, just before I started, there weren't even puts trading. And then when puts came into the market, okay, some genius who was my backer's partner in another venture, he figured out that you can do conversions and reversals and lock in profits, with no risk by just looking at the relationships and the synthetics. And no one knew this except him. And he just went nuts with all that stuff. He just made a fortune locking this stuff in, risk-free kind of stuff. And then people figured it out and say, "Oh, he's got an arb here. I get it. I know what he's doing." And then butterflies came in and yada yada. And people didn't understand those, and people were just buying butterflies for credits, right? So it was nuts. It was nuts. Yeah.
So you go in and your typical day. You got your jacket. You sit in the pit. Like, how close is it to trading places? Some buzzer rings and everybody starts screaming.
Yeah. So in those days, what happens? You go down the floor. I'm in Central Time, and that's where Cboe was, always on Central Time. So it's 8:30 is the opening, right, in the morning. You go down the pit. Yeah, I usually got there 15 minutes early. Everyone had a spot that you sort of earned in the pit, and you went to that same spot over and over again. Now, a new person, you don't have a spot. They try to get you out of there. But once you get established, you have a spot. I had a bad spot at first. Then, as I got bigger and better and more prominent in the pit, I started moving down the ladder, and all of a sudden I got the premier spot down the middle of the pit.
How long did that take?
A couple of years.
Oh,
for
okay.
sure. Yeah.
I was thinking like 10 years,
Oh, no, a couple of years. No. So yeah, you go down there, bell rings, and when you start, everyone is an opening rotation. Well, now opening rotation in the markets that the retail folks know and love today, you push a button and all the markets open up, right? The market makers hit a button. We did it individually. So we took turns around the pit. We said, hey, Dave, you open up the deeps in Google. Hey, Joe, you open up the deeps in, Meta. And we just went through it and we yelled out the markets. You look at your sheets, you say, Jan 95 call, and what's the market? And someone yells something out and someone has a better market. They yell it. We went through that process for the first half hour of the day, open up all the markets.
Wow.
Just individually by hand, by voice, doing that.
And you said, I remember you saying you traded Chrysler a lot.
Yeah, Chrysler was one of my stocks. Xerox was another one back in the day. Google, we got one of the .coms was DoubleClick, which is a great stock. But yeah, it was nuts. And you're in an individual pit, and you're responsible for what's the stocks in the pit. There's probably on average, 15-ish in the pit. So some pits were 10, some 15, 20. Some pits had a lot of little crappy ones, and other pits had some really, 3 good ones and a bunch of crappy ones. So it just depended. My pit was really good though. Chrysler was very busy.
So you trade, you're in the pit, you're in front and center. There's, I guess, a broker up there, like who's just saying, I have an order for this, I have an order for this, and you guys are screaming markets at each other? Yeah,
so it's a competitive, bidding and offering environment. What that means is that the best bid and best offer rules the day, and that's what's always displayed, right? So the way it worked then is each pit would have a stationed broker. He or she was his own entity, his own boss. They might have had clerks with them and another broker on the badge if needed, depending on how busy they were. But they owned that book. So they had outside business sent down to the pit, and they would take it and they would represent it. The old $2 broker, whatever they call them. And they charge, a commission for all those fills, right? That was the pit broker. That person never moved from that pit. They came down with me every day, just like, all the market makers in that pit did. Then there were floating brokers who walked around the floor. They would represent Goldman Sachs, Charles Schwab, Solomon Brothers, whoever. All those people had their own set of brokers. They were in a desk or a booth beyond the pits. They'd get a call from the Goldman Sachs client. They say, okay, you want to buy 1,000? Okay, I'll let you know. They'd run into the pit. Back of the pit, they'd yell out the market. We'd respond to it. If it traded, he'd break it up and they'd fill it, go back, tell the customer. And that's how it was. Very manual. A lot of phone calls, a lot of that. Not like it's automated and electronic today. Yeah. Very much writing things down. We had cards. We wrote them down. That's how I got my name Lex. It was my trading acronym. So you had to have a 3-letter badge, which for me was LEX. And then your clearing number was where your trades cleared. Our house was 671. So that when I did a trade with anyone, they write down LEX 671, put all the data on it. I bought 6 calls from Lex at $3.25, blah, blah, blah. I do the opposite, send it into clearing, and they match it. If you didn't match, guess what you have? An out trade. And then you have to rectify that out trade by the open of business the next day.
Wow. Okay.
Physically, not with a computer.
Yeah. I mean, it sounds busy. I mean, and at like the end of the day, do you have like a lot of paperwork, or, it seems stressful during the day, and it sounds like there's a lot of catch up that has to be done in the evening.
Yeah. So when I started, it was all manual on writing on paper. So we kept the biggest number for us was deltas. We always wanted to be around delta neutral. So we would hedge, constantly. Whatever we buy or sell, we'd hedge with stock. So we always wanted to be delta neutral. So we would keep track of our deltas by hand. We had a method. It was written down on the sides and, squash them out. You do a new trade, you estimate 50 delta, about 10, 500 deltas, long or short, subtract, add to the running total, right?
So you didn't have something that told you the delta of the option that you're about to trade?
No. We just knew it intuitively. So we got close. And I always like to tell people, back in that day, and even today do a little bit.
Wow.
You know, it's so scientific now. I'd say, look, it was like dropping grenades. Just get close, you'll do damage. But we were just getting close. It was 55 delta or 50. It didn't matter. I was close enough.
Couldn't even imagine that.
Yeah, right. But yeah, that was manual. And then our firm, we ultimately built a firm, but our firm was one of the first ones that started using little handheld computers to keep track of all your Greeks. So then we added gamma, theta, vega, and rho into the equation on this little computer. And it was a little crappy handheld that people would left. It would be like the old dot matrix football game. That's what it was kind of like. It was really bad. I mean, we thought it was really advanced then, but it was actually, looking back, it was terrible. But it worked. You know, it showed your deltas, and you could see, you know, up and down stock prices, what your deltas were and how your gamma changed and all that kind of stuff. So it gave us a basis, but we could change that so fast by trading a lot.
Cool. Do you still have one?
I don't. I mean, maybe in storage. I still have a lot of stuff from the old days in storage, but I might have a box of.
One day we'll do Lex show and tell then.
Yeah, it was like a Hewlett Packard little fold up thing. It was a little black thing. It was terrible. I mean, you could do what we did on an iPhone nowadays, but you know that didn't exist. So
how long were your days? Like
I said, I got down there about 8:15 to the pit. So I would get in, you know, and I lived in the city back then, so it wasn't too far. I'd probably get in the office at 8, go through my out trades, make sure I didn't have any, you know, busts or anything like that. If I didn't, you know,
what's an out trade just for?
Yeah, so the out trade is when, remember, we're doing it manually, carding things. The guy across the pit says, "Hey, Lex, I'll sell you 7," and I say, "Yeah, I'll buy 7," and then I mistakenly write down 6. He write down 7. We have a 1 lot out trade. We have to write. He goes, "Hey, Lex, I said 7. Don't you remember I said 7?" I go, "Oh yeah, I forgot. Make it 7." So we have to go back.
So you just like scratch it off. Okay, 7.
Yeah, make it 7. And then the trade checkers there with the out trade, they have a report from the clearing firm, and the clearing firm says, "Hey, Lex, he put in 7, you put in 6. We got to make this right. Is it 7 or 6?" And I said, "Oh, it's 7 for sure. Make it 7." And they just go in their systems and they redo it and do another run on after the out trades. But I got to tell you, maybe it's a good segue. In the 87 crash, we had a big out trade, and my broker asked me to do him a favor, and it was a big number. It was, you know, he had an out trade, and, you know, the floor brokers they had error accounts, but they weren't making the kind of dough that the traders were making. And he said, "Hey, this is a big one. I'm gonna make it up to you." So I said, "I take it." And it paid me dividends. Let's put it that way.
We'll talk about Black Monday later. Let's talk about specific days, because I still got, you know, a few more questions. Like,
sure.
All right, how did you make money or lose money? Like, I know you said you're trading, but you know, people get the impression nowadays that market making is such a tight run ship and they never lose money. I mean, when you see even like Citadel's P&L, it's always like straight line up. So,
so how did a market maker make money? So it's an edge game, right? Like a casino is an edge game. And I hate using the word casino because people think it's gambling. For us in the market making world, we looked at the casino as we were the house. So we had the edge on every trade that was made. We had the edge. Why? Because we got to buy the bid and sell the offer, right? On our markets. A retail person has to do something other than that. If they're lucky, they get midpoint. Okay, that's great. Sometimes they have to buy an offer and sell a bid. That's negative edge. Why? Because every option has a value. Okay, and you know that as an economist, as a mathematician, there's a model that produces a theoretical value at every stock price. And part of the input, one of the inputs into the model is stock price. Yeah. So when you have a stock price in time and you have an implied volatility and you have dividends, and you have time expiration, you have a strike, it's going to spit out a number. And that number is vital to the market maker. And they're all related to one another on a curve, butterflies, conversions, reversals. Everything's related now, or always was. And we are edge accumulators. That's why a casino has so many slot machines around that floor. And why did I pick slot machines versus a craps table or a blackjack table? Because a slot machine is electronic and you don't need to hire staff to run it. And the edge is built into the machine. It is a negative edge to the player and a positive edge to the house. And they want to have as many of those as possible because they want people playing them all the time, because they're just going to make little slivers of money every time someone puts a quarter in there. Now, granted, someone wins once in a while, right? Just like in our game, we lost once in a while. It happens. You get a bad position, a stock moves funny, you're short premium instead of long it, yada, yada, and you lose. That's part of the game. But because you have a constant edge machine and you can always be down there buying business, selling offers, you can work that loss back through just the day trading bit of your day. Does that make sense?
Yeah, absolutely.
So think of it as that I might have position risk or gap risk in a stock. That might be a negative to me, but by the end of the day, if I'm trading a lot, right, I can make that back. And I got a great example of that if you want to hear it, but it's about Chrysler and the takeover. Yeah. So a perfect example is that Chrysler really never moved back in the day. If it moved up or down $1, that was a miracle. I get a call from my clerk in the morning. This is on my way in, and I'm short premium, probably short units too, meaning big moves would really hurt. Chrysler's up $12, which remember, $1 up or down is a lot. So Chrysler's up $12. I'm short all kinds of premium. I'm short units. I'm short deltas, like crazy. And you could run your P&L, kind of your theoretical P&L at the price where it's trading. And he says to me, I go, how much am I down? So it was a very solid 6-digit number that I was down. So it was probably in the, if I remember correctly, it was probably like 350,000 I was down to start the day out. Okay. So that's a big number, right? That's big for a single day.
Yeah.
So I'm like, oh, this sucks.
You were just saying that you made that over several months.
Yeah, right. So yeah, it's all gone. And I learned a valuable lesson. Don't be short units. You can be short premium, but have units, blah, blah, blah. So that's another story. So I go down there and I said, okay, I got a big day. Well, in a takeover, the activity, as you can imagine, gets crazy.
Yeah.
So I had some of my compatriots in that pit. They didn't blow out, meaning they lost all their money, but they lost a lot of money where they mentally couldn't go down to the pit. They just couldn't do it. Which is in hindsight was a negative. They made a mistake. So I went down to the pit. I'm like, shit, I got to make some money back. I was one of the few regulars left in the pit. So all the other people around the floor knew it was a takeover. They come out of their pits, come over to our pit and try to, scam off of our markets and start trading it, which is a typical thing that market makers did back then. It's kind of scummy, but they did it anyway. But I get my spot. Someone's standing in my spot. I say to them, hey, listen, I'm here every single day. Get the hell out of my spot. I'm going to have you removed from it. So the guy says, oh, no problem. So he moves down. But the regular brokers who come in the pit and my floor brokers, they know me, right? They don't know everybody else. So they just stood next to me and just asked me for markets all day long. And these were size. So I remember Schwab came up to me and said, Lex, I need a market. I've got a market order. Do your best for me. It's 500 lots. And I don't even remember the numbers, but I'll make them up. So I said, I don't know. The normal market would have been, $3.5, 4, let's say. $3.5 at 4. Yeah. He goes, I got to sell these. Just give me a place where you can buy 500 of these. He didn't want to go deal with the other pit. I don't want to buy 500. No market maker. So I'm like, okay, I'll do it. I'll do it at $3, and that's the best I'm going to give you. He goes, all right, sold 500 at 3. So my clerk writes it up. I buy 500 contracts at $3. Okay. That's a lot of freaking dough.
Yeah.
Literally, okay, within, I would say 5 minutes, another broker from another house comes in, same option, asks for a market. I'm thinking, oh my God, I'm gonna get nailed in this. I say 2.5, 5. Remember, I just bought him at 3.5.
Yeah.
He goes, Lex, I got 500 to buy. Where can you do 500? I say $5. He goes, done. I'll buy 500 at 5.
Nice.
I just made $1.50, $150 per contract times 500. That's 75 grand in literally 3 minutes. So now my 350 is working its way down.
Yeah.
Well, the long short story is that by the end of the day, I broke even. I had 0 loss. And that's just the point of I had a big loss on a move, but I worked my butt off during the day to make that loss back. And it wouldn't have happened if it weren't busy, right? Mm-hmm. We were lucky because it was so crazy. That day, Chrysler traded more option contracts at that time back then than any equity ever in the history of options. So, and again, it was like 200,000 contracts. So nowadays the SPX does millions, right? Yeah. So 200,000 was a freaking,
most of it flowed through Lex,
and most of it flowed through me, right? So that's why I was able to get a lot of that back. It was crazy. I was really bummed about the loss, but by the end of the day, I was like, I called my wife at the time, which is still my wife actually. I called her and I said, man, we had a great day. And she goes, yeah, how much did we make? And I said, first of all, I don't have a mouse in my pocket. There's no we here. I said, we broke even. And she goes, well, that's no good. I go, knowing how I started is pretty darn good. You'd be really happy about it. So crazy, right?
Yeah, that is funny. So you were also, I mean, just to snap back a little bit, you said that market makers were coming to your pit because Chrysler got taken over, I guess, by Daimler.
They got busy. Yeah, market makers thrive on activity.
So when they came over, I guess they didn't have any book in Chrysler.
No, they have no position.
What were they trying to do? Take advantage of all the people that were gone that abandoned their book, or
a little bit, but any market maker, if markets are wide enough and liquid enough, they want to be in that environment, because remember, they're buying bids, selling offers. That's their edge. So the more of that you can do, the more money you can make. So when it's really busy like that in a takeover, you have the riffraff come out of the woodwork and show up in that pit. Now, think about it. I'm there as a regular in that pit 252 days a year.
Yeah.
Okay. That's where I make my living. And it gets busy one day and all the other scum comes out of the woodwork and comes into my pit to try to, take some of my action. Now, technically it's not mine. I get it. But right. I burned my chops in there, as it were. So, people, it's not looked on it wasn't looked on very favorably. It doesn't happen anymore because everything's electronic, and so it doesn't
everybody's matter. In everybody's business, right?
Doesn't matter. Yeah. You can be in anything. Yep. Totally different.
All right. So when you first got hired, you were given $50,000 in seed money and you lost it in 6 months.
Correct.
That begs the question: how do you get fired? What is a fireable offense?
Yeah, no, that's a good question, actually. Let me think about that. So interestingly, because I started at the same time as another one of my backers' proteges. This guy was ranked 87th in the world in backgammon. Okay. Super smart guy, like brainiac. And everyone thought he was the next gift to trading. He blew out in 6 months, blew out a second time in 6 months, and he got fired. Okay. Now, what is the point of that story? The point is that you don't have to be a rocket scientist or necessarily a mathematician to succeed in trading the way I did it back in the day. Okay. You might have to be that way nowadays, but back then you did not. You needed a couple things. You needed to be super competitive, have a good handle on game theory, game theory, poker, backgammon, that kind of stuff, whatever it is. Didn't matter what it was, as long as you understood it a little bit. You had to be really athletic. And the only reason I say athletic is because real athletes really know how to compete and win. Mm-hmm. And this was about winning. This wasn't a 12th place ribbon. Everyone didn't get a tie like they do in school nowadays, where, oh, my kid did the report and he got a trophy too. It was like you're either first or you're last. That's all there is to it. So
Ricky Bobby.
Yeah, we wanted people who knew how to compete in that environment. So we hired athletic game theory people. They were usually bigger people, and we trained them. And they didn't have to be the smartest, tool in the shed, the sharpest tool in the shed. They just had to succeed in that environment. And it worked, right? It worked. So to get fired, you really had to lose a lot and never get over the hump. You could lose once, but you had to make a comeback and show some foresight. I got to be honest, we did not fire a lot of people from our firm. It was pretty rare. Once we got them in our system, we had a whole university educational program. They generally succeeded. We did a pretty good job hiring. It generally succeeded. I mean, we probably had a handful of fires on the trading side of the world during my whole tenure there. We had a pretty big firm. At our peak, we probably had 380 people in the firm. So back in the day, yeah, it was all woven into PAX clearing. So it was good, and we just had a method, and the people we chose to execute that method were pretty good at it. So firing was pretty tough, I'd say, unless you just couldn't make money. That's the one report card you get. Are you making money?
Right. Yeah. So all right. So I guess now is a good time to start talking about some memorable moments. What was Black Monday like? Okay, so it was the 19th of October. It's a Monday, but people don't remember that the Friday before was pretty nasty too. Oh, okay. So the 16th was a big down day, one of the bigger down days we had seen. Weekend comes, all the pundits talking over the weekend, and then Monday rolls around and it's tragic. Now, don't forget, I think the Dow was down 400 points and change that day. I could look it up. And it was maybe a $1,500 index or a $1,200 index, I think, at the time. I don't remember exactly, but it was down like 26%, which is, you can look it up. It's just a gigantic
percent move. And people think, oh, 400 points is nothing. We have that all the time. I go, yeah, but the Dow's 50,000 right now. It's not 1,200. So that was the big difference.
So the Dow had lost 508 points,
Okay.
22.6% of its value.
Yeah. So that's
I remember watching Wolf of Wall Street, and you watch Matthew McConaughey get blown out.
Yeah. Right. So it was terrifying. Okay.
Yeah.
People had never seen it. There was all kinds of clearing firm problems because people sold so much premium. There's guys losing millions and millions of dollars. There's fear in the banking system. There's fear in the clearing system. There's fear at OCC because they had never seen that before. And it was scary. I was literally on the floor for 8 months at that time. So remember, I lost my money the first 6, the second 6, and I was lucky. Remember, I told you I started selling premium, figuring that out. Well, I was still in the long premium phase of my entity the 2 months after he put more money in. And luckily, because I was long premium, I was net long gamma, I made, to me at the time, a small fortune that day because, I just had the right position. It was just dumbass luck that happened. But I went down to the floor and most of my compatriots weren't there. So I was one of 5 guys who went down there and stood next to the broker. And the guy was a tough military, a Vietnam vet, he's terrifying. Everyone was scared to death of him. And he leaned over to me and I became his best buddy after that. He says, man, I got to tell you, that is a real stand-up kind of guy. This is coming from a military guy who gets bullets shot at him, right? So for him to say that to me as a young kid, I was like, oh, I appreciate it. Thanks. And he just fed me the rest of my career. Feed me, legally, but he heard me first a lot, right? Mm-hmm. So I got to kind of choose how many I wanted. But it was scary, man. I'll tell you, it was really terrifying being down there. It was a ghost town. It was quiet because no one was there. I mean, people were just like, what is going on? Is the world coming to an end? It was
everybody's selling premium. I can imagine that they if they're running away, doesn't that let their book just kind of fry like that?
You could trade from off floor. You call up and send down an order and try to manage your inventory. I mean, you're giving up edge to do that, but you're not taking on any more risk by not being there, right?
Right.
Whereas, if I'm down there and the whole investing public wants to buy more puts, guess who's selling them? Me.
Yeah.
So they didn't want to be selling more puts because they're already short a shitload of them, and they just don't want that much more risk. Mm-hmm. So I was just able to do it, and I was very methodical, and he didn't like some of the markets I made, but I'm like, listen, I'm the only gig in town right now, so take it or leave it. I'm not bending over backwards here to lose money. I got to watch myself too.
Yeah, yeah. So, and in the end of Black Monday, then you made a lot of money, and you made the respect of the Vietnam vet who was screaming at you.
Yeah, I did, and
that was a great day for you.
It was a great day for me, and I can't tell you how terrifying that guy was. I mean, I'm sugarcoating it, but he was a Illinois deputy, okay, which allowed him to carry a gun, and he carried a gun on the floor. So he was known to have, and he's a little bit loony. And he would come down to the floor, and you could see it in his back under his trading jacket, and on his rear end. And he had a handgun on the floor. He was allowed to carry it. And he definitely had PTSD, whatever they call it. You
said it was a competitive environment. That's the hammer.
Oh, he was. I mean, look at ultimately he has since passed away, but he was terrifying. And he and I became, we weren't like best buddies, but he and I became truly respectful of one another, to the point where he invited me over for dinner to a dinner party with some of the other guys in the pit to his house. And I was a young kid compared to these people back then, right?
Yeah, yeah.
So now I'm the old guy, and all these young kids are out there whippersnappering around. So it was good though. That was a proud moment for me that he ultimately respected me, because he made a big difference in my life. I will say that he was so tough on me to make markets, and he would not let up on me. And you know what? Without that kind of pressure, I don't think I would have gotten to where I got without him.
Awesome.
Yeah, he was great.
So when did you end up leaving market making?
Yeah. So the way market making evolved, I gave you all the good stuff. It got bad. Okay. So how does it get bad? Well, the wider the market can be for a market maker that trades, the better, right? More edge. Make sense? as electronics came into the equation, okay? And then remember, markets were done in fractions. So they were 1/16, an eighth, okay, a quarter, halves, etc. So we didn't have decimals. So the first cut in the armor was when they went to decimals. Now markets could go 0.01 at 0.02, that kind of thing. There were some rules in some stocks, like SPX had its own rules. It was nickels only. It's still nickels only, actually. So that was the first blow. Then we had multiple listing, second blow. So that means that my monopoly in Chrysler can now be traded on 5 other exchanges back in that time. There's 21 exchanges now, but back on 5. So it's competitive. So if someone comes to my pit and says, hey, Lex, what's the market? 1 to a half. He goes, P-Coast is showing a 105 bid. Do you want to match it? Or I'm going to send the order out there. What do you think I'm going to do? 105 bid. Okay, we'll do it here. So that tightened up the markets. That was another one. And then electronic posting came into the fold, and people started saying, oh, we can post markets electronically. So there's no more Lex screaming and yelling. These machines were starting to make the markets, and everything got in line again with the machines. So that set of things happened in succession. It wasn't like one after the other. It was, year here, year there. And then by the time, I want to say by the time 2004, 5 rolled around, it was fairly electronic. We're sitting down in the pit on a computer. They built stations where you could put your computer on it, and you could sit on a high boy stool, and there's no more output. You just sat on the machine and you just moved your machine around and you played video games on your machine. Took all the competitiveness, the physical competitiveness that we loved out of it. So then we ended up exiting the business around 2005. We sold it to Merrill Lynch, our clearing and market making business. They actually still have it. They still components of it. And that was it. That's when I left. And then I did it off floor for a while, and then ultimately where I am now got in the retail world. So it was a great run. I'm just an addict. I just like being in the game, and I love options. I love trading. I love figuring out new things for the retail folks. Retail trading, is interesting.
My next question is, what's the difference now between retail trading and market making?
Yeah, most market makers tend not to be very good at the retail side, and I would say that I'm probably, compared to what I was, I'm probably one of those people. You know why? Because retail people look at charts. I'm like, I don't know what a chart is. I can't read a chart. We never looked at charts.
I don't look at charts.
Yeah, I saw Tom Sosnoff, who was one of my compatriots. He was on the Cboe floor when I was there, and we didn't really know each other. He was in the OEX, and I was in the equity pits. So we knew of each other, kind of thing. But we didn't hang out around a lot. But he was on a podcast, months ago, and Batista asked him about a chart, and he looked at Tony, goes, I don't look at any charts. I don't even know what a chart is. And that's how we were. We didn't know that. He goes, I might look at a chart to see if it's the higher end of the range or the lower end of the range. And don't forget, market makers by nature are contrarians. Why?
Right.
Because we take the other side of everyone's paper. If someone wants to buy something from me, I'm gonna sell it. If someone wants to sell something to me, I'm gonna buy it. I'm a contrarian by nature. So I always think that things are always gonna pull back or rally from bottom. So I want to see the chart. If it's at the top, I'll sell something. That doesn't always work. So I guess my point is that being an off-floor trader, I look at the screen, I go, I have no edge proposition. What's going to cause me to make a trade? Well, we need a system like Volland to give you that information. You need a directional bias. You need a non-directional bias. Whatever it is, if you have a good system, I can give you the strategy that's going to make you the most money, okay, based on the system. But the system is the important part, the edge generator, right?
Right.
If you told me 90% of the time I can tell you direction in the next, I'll even take a week, okay, over the next week. Doesn't have to be exact. I'm going to be great. But that's the hardest part. God, I've kind of, I've kind of simmered down retail trading to a few things. And you and I talk about this on the show a lot, and you might not agree with it fully, but, short call spread, short put spread, long call spread, long put spread. Right? I stay away from butterflies. It's too complicated. Just make it simple. If I have my direction or non-direction, I'll do both. Then I got an iron condor, right? And I'm trying to take advantage of premium. Very good student of implied volatility. However, if things are cheap, I'm not selling things. If things are expensive, I'm typically not buying things. You always have to buy and sell something in those environments, but your net position might be long vega, short vega, depending on where implied vol is. That's how I use the options market as a good student of implied volatility.
Yeah, that's very important as option trader. As far as like butterflies and stuff, yes, I primarily use butterflies and and stuff like that. But, there's people that tell me, I look at charts, and I tell, people get shocked when I tell them I don't look at charts.
Yeah.
I don't know what a, wish-wash, whatever, candlestick formation. I don't even look at moving averages. People are like, how do you know when it's bouncing off the 20-day moving average? And I'm like, how do you know? Like, it either bounces or it doesn't. And it doesn't, nobody's staring at that line. Like, or if people are, they're, not just implied volatility, but discipline, I think, is how, like, when there's technical analysts out there, and there are some that are successful or profitable or something like that, the edge isn't in the data. There is no, quantifiable edge in technical analysis, and any, in Elliott waves or moving averages or, candlestick charts. Nobody has been able to prove any kind of quantifiable edge in it. It is in the discipline of, if this happens, then I'm doing this, and they don't deviate. And those are the people that are successful.
Yep, I agree with that. And what you just defined is a very systematic structure, right? And you have an entry plan and you have an exit plan, and you don't vary from it at all, right? And you may tweak it, meaning, I'm going to take 50% of my max profit, and then you say, well, you know what, that's good, but if there's only 10 days left, maybe I'll say take 70%. That's also good. It depends. And you kind of hone that part of the strategy down. 50 days ago, you'll take 50%. It's too long to go. You could mess it up. So let's take it and do it over again. I get that. That's something you need to have. And that's why I love automation so much in retail trading, because it takes emotion out of the equation. Yeah. And you just systematize it. I love that part of it. But, Gal, I'm trying to figure out the holy grail of direction, okay, or lack thereof. If I know that there is no direction, I'll do fine. That I'm okay with. But if you say, Lex, which way is Tesla going? I'm like, look at you, and I go, I have no idea. None. I don't know.
2 words for you, Bo. Aggregate Vanna.
Love it.
I've been, I'm not going. All right, so I am going to toot my horn. I'm going to say I'm not going to toot my horn, and right before I do, our Curio, we have our in-house hedge fund. That's a private hedge fund.
Yep.
Interested, anybody out there listening, you can send a note, and you could talk about it. But we haven't lost in a month since June. Like, it's measured butterflies. The only time I really lose is on the right tail at this point. That's very hard to trade. But if the market shoots up, that's what that means, everybody.
So you're using aggregate Vanna on the short side of Vanna, or the long side, or either?
Either. I mean, if aggregate Vanna is increasing and it's positive, then you're looking at a bull market. If it's negative, then it's still implied volatility has to come down. That correlation still has to exist, but that it's going to be very difficult for markets to trudge forward, and it's going to be very easy for them to pull back. So, that's really the only directional concept I use. I don't use any charting or channels or anything like that, flags or.
Yeah. And you do it, and you're looking at it more in SPX as a macro index, or are you looking at individual stocks, or both?
I only trade SPX.
Okay. Got it.
I only have SPX positions on. Or, if I want to hedge ES, but you can do it I do it on individual stocks too. One of my traders, one of our other traders, we have 3 different strategies within our hedge fund. Kyrios is the name of the hedge fund. We have 3 different strategies within there, and one of them does just equities. And, it's great because when she sees like a bunch of bullish equities and I'm seeing bearish index, we kind of cancel each other out a little bit. Yeah. But we obviously talk, but but in equities, equities is a little bit different because there's a lot of idiosyncratic risks, and the underlying is just a direct, result of the options. It's like if you have an Apple option, you can hedge it with Apple stock. But if you have an SPX option, you have to sit there and do the math and do ES and, maybe even SPY or something like that.
Right.
But that's how the fund trades. But aggregate Vanna and aggregate and gamma like levels too.
So if you got a big short gamma cluster up and a higher strike, are you wary of that? Because it can go through it and all of a sudden you get a rush?
Yep. If there's like a short gamma cluster above, Or, you know, there's a lot of times, especially recently, a lot of people are buying options, like just overall, like puts and calls. So it's short gamma everywhere for dealers because, you know, they're selling everything. They're selling whatever they can get. And so it's short gamma everywhere, but they're not really hedging unless their premiums are threatened. You know, would you agree with that? Like as a market maker, they collected, you know, if they're collecting like $3 billion in premium, they're not going to be worried about, you know, if markets ended that day and all their options expired at that moment and they're positive 3 billion, they're not going to be worried about the 1 or 2 points in between. And they make money that way, you know, overall. So, you know, so that kind of market, you know, when people like right now is mainly that's the case. And so it's kind of listless, you know, until you reach an extreme. But yeah, so that's what I look at mainly is what is the dealer's total premium holding? And when negative gamma, you know, when there's a negative gamma run and that premium holding will, you know, disintegrate, that's when I get wary, both on the upside and the downside. And then on the flip side of that, you know, if there's a lot of people selling options, which tend to be like zero DTE kind of stuff, people will sell options. Dealers are, you could tell me, they're delta hedging all the time, right? That's like dynamic delta hedging because that's how they're making money, both up and down. As long as the market moves, they're making money.
No, that's
kind of like the principles of, you know, the very basic principles and that I could explain in 4 minutes of how I trade. And then like we said, there's always trade planning. Like I have a butterfly. How do I manage this thing once I have it on? I can't just sit there and cheerlead, you know, I have to manage it. So all that kind of stuff. And hedge it too. Hedging, like they call it a hedge fund because you got to hedge all the time. But the difference, I think, between me and many traders is I'm very evidence-based. You know, when we talk about like technical analysis or, you know, even like historical things like, you know, 9 out of the last 10 garbage nights, the markets went up. And I'm like, you know, you can say that about anything, you know. It's like,
no, I know.
But I don't do that kind of retrospective kind of stuff other than knowing that like when you priced an option as a market maker, you're doing it off of realized vol, right? So other than knowing that and then looking at realized vol and saying, well, will markets ramp up or tamp down from realized vol? And then I'm going short gamma or long gamma, you know, in my trades. So, I mean, that's kind of how I trade, but I always find it funny too. You know, there's some others out there that are former market makers that are saying, you know, hey, I'm a former market maker. And because of that, I'm a good trader. And
that's not true, by the way.
No,
it's probably the opposite. I find that former market makers don't do this anymore because it's not what they know.
Right.
You know, they don't have an edge system because it's been taken away from them.
Right.
So now they've got to come up with a new edge system like what you just described. And look, there's a million of them out there. I don't care what it is. If it works and you're good at it and you can repeat it, fine. You know, just be disciplined with it. That's the critical takeaway. But that is also the hard part is finding that edge system. And I don't care what it is. Like I said, you know, your system works. There's people who use charts and they're very successful. Okay, great. Knock yourself out. I love it.
And that's why, I kind of say like, it's the system, you know, it's being evidence-based, but also, you know, if you're a market maker and you come out here, I'm finding a lot more that those market makers that come out here and talk, they are the ones selling the picks and shovels. They're not digging for gold. You know, and us as, you know, Volland and Curios and, you know, Addam, we're in it all. So we're vertically integrated.
That's good.
So, I mean, but I mean, really though, it was great hearing a lot of stories from you, Lex, about what it's like in the pit. And I guess this will conclude our first Volland Fireside Chat.
I love it.
Thank you, everybody.
Thanks for having me. I loved it. Anytime. And by the way, I've got a million more stories. So just so you know.